Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about bank M&A activity, the drivers of deals, and whether we're seeing a sustained rebound from the recent lows in the spring, and talking about if activity can come back to some of the hopes of what we thought we might see at the beginning of 2025 when it seemed like the market was shaping up for a really healthy M&A environment. Joining me on the show is Christopher Olsen. Christopher is the managing partner of Olsen Palmer, an independent investment banking firm focused exclusively on advising financial institutions on M&A. Christopher has been one of the most active advisors in the space during his career, and I believe has worked on more deals than any other advisor in the bank space over the last 5 years, at least according to our data. Christopher, thanks for joining us.
No, my pleasure. Happy to be with you. Looking forward to the conversation.
So let's start off talking a little bit about your firm. I have the benefit of getting to talk to lots of advisors in the space, and as I mentioned, you've been one of the more active ones out there. Tell us a little bit about Olsen Palmer, how it's different than other advisory firms, and where your focus tends to be.
Yeah, for sure. So our model is pretty simple, as mentioned. We're an independent firm that specializes really solely in advising community banks on M&A. And so we like to say we're sort of an inch wide, but miles deep in that space. And in approaching our practice, our model is sort of simple. We combine the expertise of a large traditional investment banking firm with that specialization, hopefully the right amount of humility, some creativity, and if nothing else, the independence and ability to sort of give good client-first advice as opposed to kind of keeping in mind or potentially being conflicted by a number of different products or services or business lines that may or may not tarnish the ability to give sort of candid advice. In terms of where we play, we enjoy working with and really focus our efforts on working with banks below, I'd say 10 billion, all the way down to 10 million in assets. What we found is that was maybe an underserved space, believe it or not. While the industry is lousy with good quality community bank, M&A investment bankers, what we found for folks kind of in that space between 0 to 10 billion, while there are a number of good quality firms, many of them are looking to go upstream, maybe for bigger paydays or just bigger revenue opportunities or more products and services. And so maybe not as good advice given the banks in those size. And then certainly within that, maybe at the lower end of that spectrum, they're getting advice from smart folks, but maybe not M&A experts, maybe accountants or consultants or what have you, that sort of a niche to give really good, high quality target advice to the right size bank. And that's where we tend to spend our time.
Well, and it served you well. It's 90% of the institutions are kind of in that ballpark you talked about, and that's about where 90% of the deals are. So it has served you well. And you've worked on both buy and sell side, but a number of sell side engagements. And one of the questions, we love to ask of particularly of community banks when they do sell, what's the driver there? What actually pushed them over the hump to decide that they want to partner with another institution? What are you seeing at this point in the cycle from sellers in terms of what actually encourages them to take the plunge? And is it different than 5 years ago, or a lot of the same things?
Yes and no. At the risk of giving rise to that Harry Truman quote about wanting a one-armed economist. And here's what I'm seeing. So in any decision to sell is, I'm sure you can appreciate it, it's a very thoughtful decision in almost every case. In fact, I frequently say, other than the decision to start the bank, the decision to sell it is probably the most important decision a bank, a board, management will make, right? It's literally the end of an era. So most, if not every client we've worked with will approach that very thoughtfully. And in some cases, they'll approach it reluctantly, in some cases with some fervor. But what catalyzes this in a sell certainly varies bank to bank, but there's some pretty consistent themes. I would say in the somewhat philosophical or strategic realm, there's a sense from many that scale is increasingly relevant, and I'm just not big enough. I hear that from banks as small as 10 million in assets to as large as 10 to 20 to 50 billion in assets. Heck, I frequently cite the press release when BB&T and SunTrust merged. It was a 5 or 10 page release, but one of the bullets right on page one of why they're doing the deal is they're too small to compete independently. And we're talking about two of the 10 largest banks in the country at the time. So there's a sense of scale. Either folks will actually explicitly sort of pencil that out and say, gosh, in order to really earn our independence, we need to be X size, and we just can't get there independently. So we're looking at exiting, or just an implicit gut sense that it's tough out there. It's getting harder and harder to compete, keep up with technology, keep up with what have you, and we're just not as profitable. So there's a sense of scale that manifests in a lot of different ways. There's also catalysts that can be in the room around competition. This has always been the case. I mean, the community banking environment's been competitive for 100 years now. I do think it hit the quality, quantity of competitors, both bank and non-bank alike. While we have fewer banks, I think you have more formidable competition from banks and from non-banks. That's a relatively new phenomenon over the last, call it 5 to 10 years. And I'm having, frankly, just in the last week or so, a lot of conversations with the clients questioning what impact the Genius Act will have, and maybe that'll accelerate the non-bank competition and further challenge the community banking business model. So it's scale and how that manifests in a number of different ways. It's competition. And then two more practical reasons that frankly probably drive most transactions, believe it or not. It's especially for banks at the 10 billion and below, it's one of two things will frequently be in the boardroom. It's either shareholder liquidity or management succession, or both. I get frequently asked to help pursue a sale on behalf of a client, and they'll say, "Well, our shareholders really need liquidity. They've been in the stock for X period of time. We're not terribly liquid, or we don't trade very much, or what have you. We really owe it to our shareholders to get liquidity." Or, definitely, in other cases, shareholders are asking or demanding for liquidity. We need out. And then the corollary is succession. And I said management succession, but in reality, when I advise folks, I say it's really, you need to think about succession for management, which sort of starts with the CEO, but also other key folks. You need to think about succession for directors, for boards. A lot of them, maybe not have as frequent turnover and what have you, but at some point, time does its thing, and you need to think about board succession, and then even shareholder succession, especially if it is smaller, relatively closely held. In fact, I do a lot of work, believe it or not, advising folks on how not to sell, and I start with those last two things: address shareholder liquidity and succession, which are not easy, but those can help staunch sort of consolidation pressures if you don't want to be interested in a sale at some point.
Yeah, those two are interesting, and we definitely hear all those, right? But I do want to pick up on those last two on board secession. Just the idea there, you think of the CEO, but to your point, if you've got an aging board and maybe you haven't recruited new directors, you're wondering, do I have people in my community who think like me, who would be a good fit for us culturally and be able to support our strategic plan, to support what we want to do here. And if it sounds like you're saying, in some cases, no, maybe we haven't done that. We haven't brought in new blood, and you start to go, well, shoot, we're not in a place to operate where we have a board that is going to kind of continue to serve it the same way they have. Is that kind of what that looks like?
Yeah, that frequently happens a lot, and I can understand it, and I don't know that I'd be an introvert, but a lot of community banks might have a relatively static board where they might not have staggered elections or what have you, and it's been the same group of folks for a period of time, or at least a core group of folks. Well, unfortunately, time is undefeated, and invariably some folks will move on or retire or what have you. And what unfortunately a lot of community bank boards aren't great at is managing for that. And maybe it's not to get too psychological, but maybe it's admitting your own fallibility or your own timeline, or just maybe heading to say whatever it is. But a lot of times when I start being engaged to more seriously help folks pursue a sale, it's because folks didn't prepare ahead of time. They kind of look around the room and they say to each other, "Gosh, we're all old." They might be in their 60s, their 70s, in some cases 80s, and they haven't done a great job of succession and recruiting new folks. At the same time, Nathan, I'd point out that there's a core, I think you already touched on it. It's also probably harder and harder to recruit board members. Maybe there are fewer folks that want to serve on a board or capable to serve on a board of a bank. It's maybe higher risk than it used to be 10, 20, 30 years ago. Maybe it's less rewarding, more obligations, liability, regulation. And so I don't know there's as much demand from folks wanting to serve on boards. There are plenty for sure, but maybe fewer than there were. So between folks not reloading and maybe a limited pool, that ends up backing some folks into a corner and having to pursue a sale because they don't have folks that are going to be running the ship not too far down the road.
And on the shareholder liquidity part, or even shareholder succession, the idea there being eh, just the idea of you might have estate planning, you might have local investors, and they're looking to diversify away, or maybe you even have new owners. Is that the kind of idea that if you don't have that next generation of owners, that you could simply run into an issue there where they say, okay, well, we need to do something. We need to have a true liquidity event.
That's right. And this, I mean, I would just zoom out and speak to, again, given our business model, we work with hundreds of community banks and solely focus on M&A. And I will tell you, shareholder succession is a big catalyst of M&A, especially on the seller side. And what can happen, a bank below 10 billion or below 5 billion or 1 billion, especially if they're privately held, they might be some sizable shareholders and or quite a few legacy shareholders, maybe founding shareholders in some cases, depending on the age of the bank. And generationally, those shareholders will change hands. And this is maybe a testimony, unfortunate, negative though it may be, that subsequent generations don't have as much interest in being an investor in a community bank, especially if they're no longer attached to that community. They might be out of state, and they'll look to sell the shares for whatever they can get for them. In many cases, it's viewed as found money, and they'll market them for half a book value or a fire sale price because for them it's zero. Now they're going to get something for it. That depresses values for the residual shareholders, and in many cases, if folks can't sell their shares, that puts pressure on the board to create a liquidity event like a sale. And so, again, a lot of folks need to sort of plan ahead for how do you create liquidity for small or large blocks of shareholders, especially if it's relatively closely held and not very liquid day to day. And there's no great answer. It might be a repurchase, it might be an uplisting, whether it's to OTCQX or eventually a path or a glide path to a major exchange. That's a pretty tough haul for a number of community banks, whether it's the regulatory obligations, the cost, and up until a certain market cap, you're not going to get a whole lot of liquidity. So there's not a great answer there. It might be a repurchase or a buyback, which is certainly feasible, but doesn't solve the full problem. And there's some issues there. And then a sale, as clear as it is, might be full liquidity at a maximized price. And so I'm not necessarily advocating for that, but again, thinking more thoughtfully ahead of time, how to create liquidity for shareholders is a key to do for banks, whether they want to sell or not.
Sure. Well, certainly from an execution standpoint, that the sale probably it seems like it could be a cleaner path. Doesn't mean it has to be the path, but I could definitely understand why you would find folks there. Which gets me to where are we kind of where are we in terms of pace of activity, and what are you seeing in M&A markets? And I want to frame that a little bit coming in. I remember seeing you at Acquire Be Acquired in January, and it was about as hopeful as we were in terms of pace of activity, not just you and I, but everybody there that I've seen in a long time for lots of good reasons. Friendly regulatory environment, valuations coming back, still feel pretty good about the fundamental environment. Then we had the tariff tantrum that put pressure on valuations, sort of put a damper on activity. But it feels like we're getting some green shoots back. We
Yeah,
talk about that a lot around here.
yeah.
Are you seeing that in your day to day work? Do you feel like discussions are picking up right now?
Yeah, what strikes me is investment bankers are hope springs eternal and speak it into an existence. So I recognize some potential bias here, but I'll say, we have practice across the country, 6 different offices, talk with lots of community banks, have pretty good level of visibility. At the risk of bragging, I think we're the number 2 sell side firm for number of transactions in the last 5 years. So we see a lot and we hear a lot. And what we're seeing and hearing from across the footprint, what have you, I would tell you absolutely deal discussions have increased considerably in the last few months. And you have a couple of things going on. First, yeah, absolutely. I remember back in January, you and I were crossing paths at AO, and there was a optimism. I don't know if it was necessarily grounded on anything other than maybe the change in the administration. But a lot of noise has happened since, primarily tariffs and questions about what the rate of Fed loosening may or may not be. But in any event, as we stand today, I'm absolutely seeing a lot of discussions, and I could attribute that to a few things. First, tariffs created a lot of noise, but maybe there's some resolution, and maybe the impact's not as bad as many had hoped, and maybe less of an impact. So there maybe get more stability in the wake of Liberation Day. Then two, you have a lot of pent up and sort of what I call bottleneck. There are a lot of folks that have been thinking about or trying to do something for the last 3 to 5 years. I mean, this could be maybe arced all the way back to COVID when we've had a couple of now black swan events that stalled M&A. A lot of folks, especially on the seller side, are 2, 3, 4, 5 years older now. They're that much longer in their contracts, that much further behind in their planned exit. A lot of those are coming back off the bench, and so you're seeing a sort of a pickup of folks that had been attempting to do something. Then you have what I call incremental. These are folks that are increasingly thinking about M&A because of market conditions, certainly challenges, competition, scale. There's definitely a cohort of folks that are increasingly thinking about M&A because of Trump 2.0, at least the regulatory environment, which is clearly more pro M&A. We've seen the resumption of serial acquirers, whether it's Seacoast or Cadence or Glacier or others, announcing subsequent deals in just the last 6 to 9 months alone. Which, man, that we haven't seen that in years. Sort of serial acquirers. That's telling you about acquisition demand, and they're not the only ones. There are others. In fact, we're working on a couple of different transactions right now where two of the buyers that I'm talking to on behalf of my client had just closed large acquisitions for them. And I said, well, is it too soon for y'all to be thinking about deals? And this is the mindset from a couple of years ago. The answer was quickly no. In this environment, no. We're ready, willing, and able to look at our next one. And in another case, I'm looking. I have a client who has a buyer looking at them, and they're also looking at something else large. And I asked the buyer, "Can you do both?" And they said, "Yeah, we could do both at the same time." Those are anecdotal, but those aren't necessarily one-offs. That's really directly a function of a much more pro M&A regulatory environment that is increasing deal activity. I'm sure you're following, you're reporting, and you're seeing it not only with some larger transactions that have been announced in Huntington buying Veritex, the rumor of Northern Trust being approached by BNY Mellon, two of the largest banks in the country. That wouldn't be happening unless they view it as more green line environment to be talking about M&A activity. I think it was either Bloomberg or Wall Street Journal reported that Synovus may be exploring strategic options. All of these are emblematic of a lot of the factors that, in short, reflect an absolute increase in deal discussions. I think that's early. I think that's going to be a years-long phenomenon for various reasons.
Well, and you said anecdotal, but we didn't have those anecdotes over the last 3, 4
Right.
years, right? So it kind of sticks out to me, and the bigger side of it is an interesting one because we really didn't see that. Not only did we see less activity, but those players were not active in the market. So one of the things that I've heard for years is the idea that you could have serial acquirers now being able to see an exit. So maybe they even look to get bigger to look attractive to
Yeah.
somebody like that. And that wasn't really an opportunity there before. And and the last thing too that I want to pick up on that on the serial acquirers bit. Sure, all three of those are great markers. And the idea that you can do two deals, that's sort of obvious. That's more deals. But I feel like I heard pretty all from the advisory community that the fact that you were worried that you could only do one in a year or maybe even 18 months meant you were more selective on that one. So it made
Yeah.
you more reticent to kind of take the plunge and buy anybody. Do you think that's fair?
Yeah, absolutely. It's fair. Again, in our line of work, we frequently talking to buyers and ask them their opinion. Where do you want to buy? What should we keep you in mind for? What doesn't make sense? And I could earmark a distinct change in the mentality of most of those conversations where wind the tape a year ago and they would say something along the lines of many actually use the metaphor of I've got fewer bullets in my gun, I'm going to shoot them much more sparingly and only at the right opportunities. In other words, the bar was pretty high. There's a buyer I know of that literally has a short list of 5 targets, and they said we would do a deal for one of these 5. For anybody else, I'm not so sure. Fast forward to today, many of those folks that use some version of that bullet metaphor, just more of a practical description thereof, they're saying, I would be interested in more deals. I might go lower on my asset side threshold. I might go further out in geography. I might buy something that maybe is a little bit scratched and indented. That one anecdote I just mentioned that we're calling a conversation with a buyer using that bullet metaphor. I've talked to them in the last few weeks and said, yeah, no, I'd be open to taking meetings with smaller banks or such and such. And there's a clear more openness and frankly it just boils down to broader acquisition demand from a subset of buyers. I might just elaborate, it's sort of a tangent, but the biggest risk though, it's going to increase demand, but all else equal, I've seen in the last 20, 25 years of my career is that the buyer list overall is shrinking. You mentioned, some of these serial acquirers might be themselves improving their franchise value to open up an exit. I do think, and I'm advising my clients, that less regulation is good, but not all good. Think about it this way: what if, if I'm talking to a billion-dollar asset client, the typical buyer is about 5 to 7 times as big as the seller. So what if the 5 to 10 to 20 billion dollar banks are now more able to sell themselves because the 10 to 50 billion dollar cohort or 10 to 100 billion dollar have now a green light to buy? A lot of my community bank clients, I'm saying you should be very aware of your buyer list, and it's likely going to shrink at an accelerated pace over the next 2 3 years. And just keep that in mind. Doesn't mean you have to do anything one way or the other. Just be aware of that change because it is affecting the buyer landscape.
Right, right. And if you're thinking about your strategic plan, and one of the possibilities is that we might have an exit at some point in the next 3 years, or we'd like to entertain offers there, or even maybe even more active than that. I've always heard the analogy of dating, and you talk with your partners, potential partners, and date with them. What if they're not on that potential list because, again, as you said, they're not independent? How does that change what you're looking to do? I mean, what do you think that does? And that's really hard to ballpark, I know, but what does that do to the billion-dollar bank if suddenly they have fewer buyers? Do they have a buyer? Is it a different buyer? Is we haven't seen credit unions necessarily at that size. We've seen some, but is it the credit union landscape? Do those institutions have to think about ways to gain scale themselves to make themselves more attractive if an exit is eventually what it looks like? I know there's a lot in there, but if that $5 to $10 billion acquirer might not be there that you were hoping for, what do you counsel that bank to do and start thinking about?
Yeah, that's a thoughtful question, and we do have those thoughtful discussions with our clients. I think the good news is we're not there now, where the typical billion-dollar bank doesn't have a buyer. I would say where I think we are for most, there are not many buyers. Most banks like that. There's not, 20 years ago, it used to be you'd put a bank on, you'd be hired to sell a bank and you put a book out. It literally was a hard copy book, and you sent out to 20 parties. You might get 10 to 15 offers. Now, for a typical billion-dollar bank, depending on where it is and how good it is and the business model, what have you, you might have two or three possible buyers. You might just have one. And so for now, for most, there's options. There's just fewer of them, which may or may not translate to valuation, right? Depends on if the right buyer is willing to pay the right price. You only need one. But I could see a scenario in 3 to 5 years that list goes from two to three down to one, potentially down to zero. And therein lies some tough decisions. Are there other types of entities you could sell to? Are there different things you could do to maybe graduate to a larger class, whether it's a merger of equals or some acquisitions yourself, so that you graduate into a different cohort of potential buyers? We're not there yet, and for some you are, but I'm trying to give my folks candid advice that depending on where you want to go and when you want to do it, keep all this in mind because things are changing relatively fast now.
What about below that level? I think that's a really interesting point you made at that $1 billion, because it's not something we necessarily thought about. But I feel like we've talked about, if you're the 200 or $500 million bank, that is challenging. If you're looking to raise your hand and say, I want to partner, maybe I'm overstating it. This is challenging is I think, but what does that look like? I'm sure it matters about the market. I'm sure it matters about the deposit franchise, particularly if you're in a good rural market and have a great deposit franchise, like maybe a fast growing bank in a metro market likes that. One, are you seeing things like that, or what broadly do you see as options for institution like that?
It's interesting. It's similar but different. At a bank, let's say 0 to 500 million. And I get, as an aside, I get asked this question a lot. What's the best size, or what size do I need to be at, either to stay independent or to buy or to sell? And I don't know, folks like me that might think that way in terms of other business lines, whether to go public or whatever. But my answer is there's no perfect number. Relatively speaking, if you're looking for scale, for greater profitability, it's linear. The larger you are, hopefully the more efficient you are, the more profitable you are. So there's not necessarily hard cutoffs that if you need to get to 100 or to 500, but for, let's just say, roughly banks below a billion or below 500 million, they have the similar challenges with a shrinking buyer list. I might say they tend to have a few more buyer options, if nothing else, because to your point earlier, Nathan, that's where the majority of banks are, right? I think 60, 70, 80% of banks are below a couple billion. But the buyer list does depend on where it is, right? Urban versus rural, what state it's in, and there's this asterisk around credit union transactions, which is a thing, right? So there's maybe more optionality, But at the same time, while buyers are willing to go down a little bit in asset, a lot of buyers will say, "Gosh, you might be too small to fool with. Is it worth my time to do a deal this small? Where if it's going to be time and effort to do a deal, I want larger. I want a 500 million or a billion or 2 billion." So similar, but maybe slightly different challenges in buyer sets.
Well, in closing, I'm hearing at least green shoots, if not more, in terms of what we're seeing in pace, seeing the stars kind of aligning. What do you think takes us even further than where we are today? Is it just simply time and not having a black swan event, as you talked about, and these things in the pipeline starting to hit? And what is the biggest stumbling block that remains in the front of transactions?
Yeah, I would say I think time will help. In particular, time will help further catalyze deals if only for additional stability, right? Everybody's looking for stability, particularly in the wake of the tariff announcements and hopefully a little bit of visibility, but at least stability, better understanding there. Hopefully, better understanding and visibility on what the Fed might do and not do. I don't know if that's a significant catalyst or inhibitor of deal activity, but clarity will help. What will likely, we're already seeing it. I don't know if I mentioned this up front, but deal activity in the first half of the year, we do a mid-year review newsletter where we sort of analyze the marketplace. First half of the year saw 20% more deals than last first half of the year, 70% greater deal value in the first half of 25 versus the first half of last year. So it's definitely already picking up. You've even seen even more activity in July. You're going to see it. There's an axiom that's time worn and worn out, but it's apt that deals beget deals. So a little bit more time, some stability, and as you see more and more of these transaction announcements, that will foster others to be thinking about buying, selling, merging, or staying independent and how to position to do that. So I think all those will help. The inhibitor right now is, it's funny. I'm doing this a couple decades, almost 30 years now. There's always a bid-ask spread. For as long as I've been doing this, I remember the early 2000s where folks were selling for 3 or 4 times book. I would hear sellers say, "I'm not going to sell for a penny less than 4 times book. I'm not going to give the bank away." And buyers sort of squawk is, "I'm not paying more than 3 times book." And there's always been a bid ask spread. I saw the same in the opposite during the financial crisis, around half a book or book. So there's still a bid ask spread. I had a client yesterday tell me, "Well, I'm not going to sell for anything less than 175 a book." So there's still a bit of a bid ask spread. So what might help is continued recovery in bank stock prices, right? Maybe a little bit more price discovery where we're at on public stocks and on deals and some larger announcements. That's probably the biggest inhibitor is maybe just the bid ask spread. But that's always been a thing, right? As sure as mom, apple pie, and taxes.
Well, and stability or instability, better said, is something that could only drive that wider and put valuations in flux. And to your point on the catalyst side, stability and continuing to chug along has to beget more deals. There's a higher price for certainty, and there's a lower price for uncertainty. And with that certainty, not only comes valuations, but we're starting to see some capital raising coming back and starting to see some war chests get built. So it does feel like we're lining up for a much busier second half of the year and probably carrying into 26. And imagine we'll see you on plenty of those transactions. So appreciate you taking the time to talk with us.
No, I enjoyed it. Enjoyed the conversation. Thanks, Dan.
Thank you.